Welcome, and thank you for attending today's webinar, which will serve as our 2020 annual membership meeting since we could not meet in person. I'm Jackson White, President of the Colorado Self-Storage Association. Because of COVID-19, 2020 has been a difficult and challenging year, and it's not over yet. And as we all know, so were 2018 and 2019. I have a few brief announcements, and then we'll move on to our first presenter. We want to be respectful of your time and will keep this webinar to less than an hour. I would like to thank our board members who have continued to work hard on your behalf this past year. Megan Berger, Kevin Cohen, Jeff Kinder, Mindy Levy, Chris Muir, Tom Razzo, Hank Sate, Barry Sherman, Dale Stewart, John Sutter, and Ben Vestal. I would also like to thank Todd Mackintosh Legal Counsel to the board and Maggie Thomas, our association administrator, who has made this webinar possible. Here is a recap of the year 2020 so far. We remain steady in our membership over the past few months. We remain above 300, and we're very proud of that. Operated in the black again this year. The nominating committee would like to report that Hank Sate, Barry Sherman, and Tom Razzo have agreed to continue on the COSSA Board of Directors. As you probably know, a repeal of the Gallagher Amendment is on the ballot, and we would encourage everyone to carefully consider the pros and cons of Amendment B when you cast your ballot. A lot of self-storage facilities were directly impacted by the increase in property taxes this year. No matter what your political party, be sure to exercise your right to vote. The association is busy working behind the scenes on some self-storage issues, and we may need your help in the next few months. So if we call, please answer. Mark your calendar for Tuesday, May 25th, our 2021 meeting and trade show at the Hilton Inverness Conference Center. Watch your emails after the first year for information about that meeting. Stay safe and happy holidays, everyone. See you in 2021. I would like to thank Ben Vestal, Argus Self-Storage Advisors, and Todd Mackintosh, Legal Counsel to the board, for their part in this webinar. Ben will give us an update on the Colorado self-storage investment market, followed by Todd Mackintosh with legal answers to a few of your questions. Thank you.
Hello, and thank you for inviting me today to present on the Colorado self-storage investment market. I think we'd all agree that the market is very fluid today and changing rapidly. So because we're recording this in October, there's a good chance that the market will have moved by the end of the year. But I do feel there are some key points we can touch on today that will help you all navigate the buying and selling process today. It is clear that the self-storage business model is what sets us apart from other real estate asset classes. We have month-to-month leases, no tenant improvements, low capital improvements, no leasing commissions. We can also adjust pricing daily to drive demand higher if needed. This is what has made self-storage one of the most desirable asset classes to own in good times and in bad. It's been a long run for the self-storage market here in Colorado. 2016 and 17, we had arguably the best self-storage market in the country. However, the last few years have been challenging in Colorado with all of the new supply. However, in the last 6 to 12 months, we've had all-time record high valuations, a very fluid and robust lending market, a tremendous amount of equity looking to invest in the industry, and most of the 2017 and 18 new developments are starting to reach stabilization. And we clearly have more buyers than sellers today. I think it would be productive for all of us to consider where we are in the real estate cycle, because one thing is for sure, is that we are in the storage business, but it is the real estate business that makes us money. This slide shows the psychology an investor goes through during market cycles. And today, you can see we're somewhere, I think we're in that anxiety or denial or fear But we all remember the times in 17 and 18 when we had excitement, thrill, and euphoria. Now, nobody knows how long this real estate cycle will actually last. I actually believe the economic cycle today will be much shallower than our 2008 and 2009 economic recovery. So I do feel that we'll see some fear, but we'll start to see excitement and optimism creep back into the market by the end of next year. I think it is important that we look at the national economy. It has clearly had an impact on the Colorado market as of recently. Nationally, we have recently seen the end of the longest U.S. economic expansion in history, and the U.S. economy had been growing for almost 11 consecutive years. Over the last 11 years, the GDP growth had grown 24 or 25%. It was one of the slowest economic recoveries in history. The GDP growth should have been 35 or 40% over the last 11 years. This was a very slow and controlled recovery, and it ended not because of some financial or economic event. It ended because we had our first global pandemic and our economy was forced to shut down. Economic expansions don't die of old age. Many other developed economies such as Canada, the UK, Spain have all experienced economic expansions that have lasted more than 15 years. And Australia just recently ended the longest economic expansion of 27 or 28 years. So it's important when you think about real estate cycles and economic expansions that you understand, that you ask when, or that you don't ask when, but you ask why the economic expansion ended. We must always be looking around the corners. That's what makes us better investors than our counterparts. And we're in the real estate business to make money. Today, the self-storage industry is facing some real obstacles, but there are clearly some bright spots on the horizon for Colorado. In the short term, I believe that the COVID-19 disruption is a concern for everybody in the market. The large unemployment around the country of almost 7.5 million people is concerning, and people are concerned that we're going to see rising delinquencies. Are we going to see a second lockdown or a second wave of the virus? Nobody knows, but those are concerns, and those are headwinds that the investment market is facing today. The other thing that this Colorado self-storage market is facing is the significant new supply that has driven down rates and increased promotions over the last several years. This has dominated investor concerns in 2020. Denver was one of the hardest hit development markets around the country, along with Nashville, Portland, Charleston, Raleigh-Durham, and Charlotte, just to name a few. However, new supply is flattening. It's not drastically declining around the country, but in Colorado, it is flattening and declining somewhat. There are still lease-up pressures, and I believe those are going to remain for the next 2 to 3 years in most markets. However, the outlook for 2021 for Colorado is positive. Today's stabilized assets will remain the most coveted acquisition. Today, I would make an argument that your stabilized asset is worth more today than it was even before the COVID disruption. C of O deals and lease-up deals are even more challenging, though, because nobody knows how long it's going to take to lease up, and more importantly, what rental rates you're going to be able to achieve. I've recently had conversations with owners about whether they would rather be 70% full at $1 or $1.10, or 60 or 95% at 60 cents. I think it really depends on your investment price, and we'll touch base on that later in this presentation. The demand for self-storage has been strong throughout 2020, and we are very pleased to see that September and most of October has turned out to be a very strong leasing season. We actually had an extended leasing season this year because September looked a lot more like July or August. You know, there's clearly expense pressures, and I think they'll continue in 2020. Operating expenses have grown tremendously over the last couple of years, and the once cost-conscious self-storage industry is now facing a situation where they need to look at their operating expenses and make adjustments. Real estate taxes have grown faster than any other operating expenses, but online marketing is growing very fast, and payroll costs have also risen rapidly. Capital markets today remain very strong for self-storage investments. There's a lot of debt and equity available for self-storage investments, especially stabilized assets. This is largely due to a lot of commercial real estate firms diversifying their portfolio and growing their self-storage allocations and looking to make more investments in self-storage. Owners in Colorado have also benefited from the overflow in the tightening industrial market around Colorado. The industrial market around Colorado might be as tight as it's ever been, and we're finding a lot of small businesses are finding self-storage to be very useful places to conduct their business, to store overflow inventory, and we've seen a lot more business customers come into the market as of late. However, one thing is clear, is the capital CapEx requirements and operating expenses will continue to trend higher on new third generation properties. 80% of the new properties that have been built in the last few years have been multi-story third generation properties, and these will have higher operating expenses and higher CapEx requirements as we move through, as they age and move through the investment cycle. Let's talk about how we're going to make money in the self-storage space. I think we're all here because we want to invest in self-storage or have a self-storage investment. And the first question is, what's creating value in the self-storage space? Today, 90% of your value comes from your NOI or cash flow. Self-storage is a cash flow business, and it always will be. The other thing that we all need to focus on is rising operating expenses. There's been a large emergence of platform-based management companies like Extra Space, CubeSmart, Argus, Absolute Management, have all come in and standardized operating expenses in our industry, and therefore we've seen rapidly rising operating expenses across the board. Has the development wave ended? I'm happy to report in Colorado, I do believe the days of 20 and 30 and 40 new developments hitting the market has ended for the time being. What opportunities are we finding in today's market? Today, there are opportunities in the market. It's largely finding undermanaged properties, embedded value within existing properties, or expansion opportunities on existing properties. The next one is, what is my investment horizon? Today, your investment horizon is more important than ever. I can tell you it's taking 6 to 12 months for a buyer to sell their property today in the Colorado market. And that market can change a lot in 6 to 12 months. Just think how different the market was in the second quarter during the COVID disruption to where it is today. And lastly, the self-storage market fundamentals are improving in Colorado. We have seen occupancies reach almost all-time highs, close to 90, 92%, and I believe that those will continue to grow, and we'll see pricing power come back to the owners by the end of 2021. Let's talk a little bit about self-storage performance as it compares to other asset classes, and largely the reason why we're seeing so much new investment in self-storage. NAREIT is an investment group that tracks total return to investors by all the major commercial real estate sectors, such as office, industrial, retail, and apartments. And over the last 15 or 20 years, self-storage has largely been the top performing commercial asset class of any commercial assets for investors to invest in. However, in 2017 and 18, we started to see that slow down and returns started to flatten. It's also when we saw the new supply hitting the market. And self-storage actually lost the 15-year run of being the best commercial asset class to own. And we saw industrial and apartments outperform self-storage. However, I do feel we are the best asset class to own, and I do feel that over the next several years, we will see self-storage back on top. Let's take a look at the national occupancy and rental rate trends. These trends are revealing some very interesting data. As you will see, this chart shows the asking rent for a non-climate 10 by 10 and a climate 10 by 10 in occupancy on a national average. This chart actually shows occupancies falling while rental rates remain firm. I believe the opposite is actually happening in Colorado and nationally, but the data has not trickled down to the service providers yet. We know as self-storage professionals, as occupancies fall, so do rental rates. As we lower our rental rates, more people are willing to store, and we widen our customer base and occupancies firm up. We have clearly seen this in Colorado over the last few years as we are filling up all the new supply. We've seen occupancies remain pretty firm, but rental rates really fall. The good news is that Colorado was early into the development cycle this time, and we are recovering much sooner than the national market. Because rental rates are falling and occupancy is holding strong nationally, we are replacing higher paying customers with lower paying customers, and this has put undue pressure on net operating income. This slide reinforces what is happening across our industry. Self-storage REITs have had NOI downward pressure for more than 21 consecutive quarters, and we actually saw the self-storage REITs report a negative NOI growth in the second quarter of this year. This data indicates that peak performance was sometime around 2016 when we saw the most aggressive underwriting as buyers were underwriting aggressive pro forma valuations due to compelling operating performance and market fundamentals. However, it is worth noting that even though we're off peak valuation today, we're still within 10 or 15% of all-time high valuation. And Colorado is leading the way with regards to recovery and valuations across the board. The slowdown in supply, rising operating expenses, and unemployment and more platform-based managed properties has led there to be very little low-hanging fruit available for investors to find today. One of the major things that we've seen over the last couple of years is a slowdown in transactional velocity nationally. As you can see, back in 2015 and 16, we saw all-time high transaction velocity, but also all-time high valuations. And the valuations is the number of is the dollars in blue there. And as you can see, we've seen a slow trickle off over the last several years, but this is largely due because of the investment concerns that are in the market and the lack of low-hanging fruit and availability of value-add opportunity. Because the cost of debt has an effect on the overall investment market, I think it's important to talk about where the debt market is today. Because the cost of and availability has an effect on the sentiment of the investment market, even though most offers today are all cash offers with no financing contingency, cost of debt is still a major driver of valuation. Remember, self-storage, what made self-storage great is that we're a cash flow business, and the debt markets have really helped that. As you can see, the yellow line on the top is the average self-storage cap rate over the last 20 years. We've seen a steady decline from almost a 10 cap to a mid-5 cap range today. The green line is the 10-year treasury. This is the benchmark for all commercial real estate loans, including self-storage. We've seen the 10-year treasury below 1% for the majority of 2020, and I don't see it rising anytime soon. And the blue line is the spread between cap rates and interest rates. This is what makes the game worth playing. As you can see, back in 2005 and 2006 and 7, we saw the spread between cap rates and interest rates somewhere between 300 basis points and 250 basis points. As we went into the financial recession of 2008 to 2010, we saw that expand to almost over 500 basis points in 2009. And then over the last 10 years, we've slowly seen the spread between cap rates and interest rates compress to the low of 2018 of 2.99%. But what we have found over the last few months, and certainly in 2020, as the 10-year treasury has been around 77 basis points, and cap rates have actually compressed about 10 basis points, is we've seen the expansion of the spread to over 470 basis points. This leads me to believe there's still tremendous opportunities in the self-storage space. Let's talk about the market today and where we are. Many of the items that we see listed on this list would indicate that we're on the downward cycle of a real estate cycle. However, 2020 is shaping up to be a much different year. We've had the COVID disruption. We clearly have new supply pressures, not only in Colorado, but around the country in a lot of markets. The rental rates are clearly still depressed, and there's still pressure on rental rates in some markets, albeit I think it's improving in Colorado. The lending environment is incredibly robust. This one topic, the lending environment, probably has more to do with the value of your facility today than any other factor. Real estate taxes. I know us here in Colorado have seen real estate taxes double or even triple in some cases, and that is a major value impact today on the self-storage space. Rapidly rising operating expenses. We're going to continue to dig into that, as I think that's something that we all need to think about today. The secondary buyer pool is very large this cycle. In 2006 to 2008, the secondary buyer pool would have been 50 or 75 groups deep. Today, that secondary buyer pool is more than 200 groups deep, as there's more and more equity looking to invest in the space. And there's just more equity looking at self-storage as a viable asset class, largely due to the well-documented performance over the last 10 years. The self-storage REITs are still very disciplined today. They are buyers. They can be the most aggressive buyers as they have the cheapest cost of capital. However, they're incredibly disciplined and are finding other ways to add value to their shareholders, such as their third-party management platforms, and Extra Space has created a bridge lending program that has been successful. Many of the items on this list would indicate that we're on the downward side of a real estate cycle. However, this cycle is developing differently than other real estate cycles of the past due to the slow growth of the economy over the last 11 or 12 years. This recession could be a very shallow one. A V-shaped recovery is what I'm predicting. And as the financial institution and investors are very well positioned to continue to provide liquidity to the market, and new construction is clearly slowed around the country as we've seen absorption of the new supply over the last couple of years here in Colorado. And the delivery of the last 3 or 4 years will be absorbed more quickly than we once thought. We're starting to see this in the market today, and they're largely due to population growth. As you can see in this slide, population growth has been robust in Denver. This shows Denver from 2016 to 2018 having a population growth of an average about 1.5%. This puts us in the top probably 10 or 15 markets in the country with regards to population growth. And I believe 2019 and 2020, we will also continue to see more than 1% population growth. And if you're like me, I believe the one thing that grows self-storage demand more aggressively than anything is population growth. And we're here to make money, so I think it's important to, as you invest in self-storage, I think you got to understand that Colorado is one of the most aggressive and fastest growing markets in the country. Today, Colorado's population is larger than ever and growing. That's why we saw more than 50 self-storage projects be delivered in the last 3 to 5 years. Yes, it's been painful, but we are on the downward slide of the absorption. And our population, even in light of COVID, this year will grow more than 1%, making Colorado one of the most robust markets in the country to invest in. As you can see on this chart, we actually saw an increase in population from 2018 from 2017 to 2018. So we were actually accelerating as we went into 19 and 20. Let's talk about new supply. As I mentioned earlier, we have seen more than 50 new self-storage projects developed in Colorado over the last 3 to 5 years, making us one of the most active development markets in the country. However, today we are seeing far less. As you can see in the Denver metro area, we're tracking roughly 15 new self-storage developments with only 5 under construction. This is a sharp decline from the previous years where we saw 25 or 30 new developments in the Denver metro with 20 or 30 under construction. And I have to tell you, I don't believe the 7 planned or 2 prospective projects, and most of those will even be built. In Colorado Springs, we're tracking 7 new development projects, 4 planned, 1 prospective, and we know of 2 under construction. So the question is, how many of these will be built and how will they affect your property? Remember, self-storage is a very market-specific industry, and if these properties are being built across town, they're not going to have much of an impact on you. But if they are being built within your submarket, it's important that you position your property accordingly. I'm very happy to report that we are starting to see most of the new developments reach 85, 90% occupancy, and I fully expect rental rates to recover in the summer of 2020 along the Colorado Front Range, largely due to the slowdown in new supply. Let's talk a little bit about operating expenses. However, we've all seen a decline in our rental rates and revenues over the last few years due to the new supply. All of this has forced us to take a hard look at our investments and make adjustments when necessary. I would highly encourage everyone to take a hard look at their operating expenses, as we have found that many owners have very inflated operating expenses, and the best way to gain back some of your lost NOI and value is to cut unnecessary operating expenses and be able to draw a direct correlation to your operating expenses and value creation. With values remaining very strong in Colorado, you can recapture somewhere between $12 and $20 of value for every dollar in reduced operating expenses today. This means that you don't need to get back or might not be able to get back to the revenue levels of 2015 or 16 anytime soon, but you can gain back some of the value with a careful examination of your operating expenses. My team here, Joni Lucas and Cole Carasello, are providing free operating expense reviews for any of our clients that would like to receive one. Please reach out to them and let them know if you'd like to see how your operating expenses compare to national and local averages. And we're happy to provide you a report showing that. So please contact them if you're interested. Let's talk about Colorado's Front Range same-store performance. I've used this chart several times when I've spoken with you guys, and as you can see, I tracked 3 of the major REITs here and then 20 different independent operators. And I can tell you, the one thing that is clear from 2019 to 2020 is all but one of these 4 groups saw meaningful growth in occupancy. We saw Extra Space grow more than 2.5%. We saw CubeSpark grow 0.7%. NSA actually fell off a little bit. They saw a decline of almost 3% in occupancy, and the 20-store independent owners actually grew almost 1%. It is still concerning to see negative revenue growth, but that is slowing. As you can see, somewhere between 4 and 3.5%, we see revenue growth slowing from 19 to 20. So we're still seeing supply pressures, and that's largely due to rates. Whenever you see occupancies growing, but revenue growth going negative is largely due because we're replacing higher paying tenants with lower paying tenants. But the one most and then the biggest numbers here is the operating expense growth. As you can see, Extra Space was able to trim their operating expenses by 6%. CubeSmart actually had a tough second quarter. They actually saw operating expenses grow 12% in Colorado. NSA was able to reduce them by 5.2%, and the 20 independent operators were able to reduce them by 2.2%. So as you can see on the left, the NOI growth in Colorado have all been negative, but the positive takeaway from this slide is really the occupancy, guys. Whenever we see occupancy growth like this, we know that revenue will trail occupancy, and it's just a matter of time before we'll see our revenue growth pick back over into the positive range, and we'll see that NOI growth grow as well. Let's talk a little bit about sales comps. Colorado is still a very active self-storage investment market. We've transacted more than 5 self-storage transactions so far in 2020 and have 3 or 4 in escrow that are scheduled to close by the end of the year, which will be a very robust transactional year for self-storage in Colorado. As you can see, there's some examples of 2020 sales comps. We sold a deal for $3.3 million, $68 a foot. We sold one for $8.2 million, almost $92 a foot, and one for $4.5 million, almost $67 a foot. Now, albeit the per square foots are down, but with the transaction velocity, it's still very strong, and the cap rates are still very strong. We're seeing cap rates along the front range somewhere between 5.25% to 6.5%, and then in secondary markets in the mountains and Western Slope, we're seeing cap rates more around that 6 to 6.5% range. However, these cap rates are tax adjusted, and I think that's really what is having the biggest impact on the price per square foot that we're achieving today. Is that they're taking a trailing 3 or 12-month operating expenses and revenues, but they're adjusting the taxes for a post-closing tax adjustment. We have recently been involved with a lot of very creative and effective structures that have allowed our clients to achieve higher prices, largely due to our understanding of how the buyers are looking at the structure of a deal. We've been involved with a couple entity sales as well as some price allocations. So if you are interested in learning more about these structures that we're implementing today to mitigate the real estate tax situation, feel free to reach out to me after the webinar. But these are extraordinary times, and I can't say it more clearly than real estate's not a spectator sport. You need to be actively managing your investment and reviewing your investment horizon. And the good news is that there is still a lot of transactions happening here in Colorado. I used this slide last time, and some, and I think it's really clear that some are going to make it here in Colorado and some will not. And I can tell you, a year or so ago when I presented to you guys and I used this slide, I felt it was about 50-50. We had 50 people like the guy on the left skiing a nice hard powder run. It's challenging times, but you're doing well, you're skiing it well, it's feeling good. And then we had about 50% of the owners and operators in Colorado that were about to wipe out. I think that we've had about 25% move over to the guy on the left. So I feel about 75% of the facilities in Colorado are kind of out of the woods. They've leased up, they maybe haven't achieved the rental rates that they thought they were going to achieve, but they're full, they're covering their debt service, and there's less stress in the market today. But there are still about 25% of the facilities in Colorado that are in danger of wiping out. Their banks are going to require pay downs of their existing loans, that they're not meeting their debt service requirements. But that's a real positive sign, as we've seen almost a quarter of the facilities that maybe had an issue, or half the facilities that maybe had an issue in 2019 move over to the better side there. So we can all be like the guy on the left skiing that nice powder run. I always like to leave everybody with some market predictions, as I think it helps everybody kind of think about their investments in some ways that they can improve their investing and really create some value and position their assets. But the first one is rising real estate taxes and operating expenses. I can't bang that drum hard enough or loud enough. You guys really need to review your operating expenses, make sure that they're under control, and make sure there's a direct correlation for every dollar that you spend in operating expenses to value creation. I think that's really the key to success in today's market, is running your property really lean and mean. Self-storage NOI growth will start to increase by the end of 2020. I can't tell you how good that feels to say, as we've had 4 or 5 years here where, I've been reporting kind of doom and gloom that the Colorado market was not performing well, but I do think we're on the other side of the supply glut. I do think we're going to start to see NOIs grow by the end of 2020. I do believe NOI will be flat for the rest of 2020 and in the beginning of 2021. By the end of 2021, I think we're probably 6 to 12 months out from really starting seeing NOI growth. The impact of new supply is going to start to burn off towards the end of 2021 as the multi-year lease up of 17, 18, and 19 deliveries are stabilizing. And the good news is the lending market is still incredibly fluid. You can still get historically low interest rates on your loan. There's a lot of very active debt providers, local regional banks, life companies, CMBS debt is all open for business. If you'd like contacts at some of the local lending facilities that we've worked with, please contact me afterwards. Construction loans have tightened. This is probably the best thing that's happened to everybody, is the banks have actually done a really good job of underwriting new construction deals this go around, and they've found solid sponsors, solid developers with strong balance sheets, and really there's been very few ill-conceived projects. There have been a few, but very few for the amount of projects that have been built in Colorado. Physical occupancies will continue to grow in 2021. They grew in 2020, 2 or 3 basis points. I think that we're going to see 93, 96% occupancies across the board here in Colorado by the end of 2021, which will be very good. Transaction velocity will increase in Q4 of 2020 and 2021, and that's largely due to investors' concerns about fundamentals, real estate taxes, policy changes to the capital gains tax. We do have buyers today that can and will close in 2020 if you do have concerns about capital gains tax. But I think that with this upcoming election, there's a lot of folks that are repositioning their investments to take advantage of the current tax code. The disconnect between buyers and sellers, I think, will shrink in 2021. I think we're going to see buyers and sellers come together on what an agreed upon value is, because I think properties are going to be performing better in 2021, and I think buyers are going to be more aggressive in 2021 due to low interest rates. And lastly, on that topic, smaller deals will be king. I've had a lot of very savvy real estate investors recently tell me it's a lot easier to make that $3 or $4 million deal worth 5 or 6, opposed to making that $10 million deal worth $17 or $18 million. So smaller deals are continue to be king here in Colorado. Rental rates will start to trend up in some markets in 21, and I do think we'll start to see concessions expire. The secondary markets are going to continue to outperform the major markets. However, be cautious of the mountain markets. I do hear of a lot of new development being planned and done up there, and that's a very thin market up there, very transient-oriented market. And I think, but for the most part, I think secondary markets will continue to outperform the major markets. And in my 25-plus year real estate career, whenever we have an election year, it keeps the current real estate wave going. Is folks that are active during the election years, whether you're buying or selling, you'll end up in a better spot. The folks that just don't do anything and are paralyzed by the election are typically the folks that have some issues after the election hits, because they just really haven't positioned their investments accordingly. So clearly, 2020 has been a year of challenges, and it's certainly the most challenging year in recent times that I can remember. Not to mention, Colorado's self-storage market was already dealing with new supply pressures and very rapidly growing real estate taxes. However, it's clear we're on the other side of the supply issue as an industry here in Colorado, and we seem to be making some progress, albeit slow progress, on the real estate taxes here in Colorado. I do think the Colorado self-storage market is poised for a strong 2021 and really improved performance, and that feels really good to say after the last few years that we've had here in Colorado. So as I've mentioned several times throughout this presentation, Colorado is doing well. I do believe the overbuilding is slowing here, and 21 will be a much better year for Colorado self-storage operators. Thank you guys all very much for your time. My contact information is on the slide up on the screen, and if you have any questions, please reach out and I'd be happy to answer. Thank you very much. Have a good afternoon.
Good afternoon, everyone. My name is Todd Mackintosh. I'm an attorney here in Denver, Colorado. And for the last 8 to 10 years, I've served with the board of directors of the Colorado Self-Storage Association. And as many of you all who are watching this webinar today may know, twice a year I come and I speak to the Self-Storage Association group, both at our spring meeting and our fall meeting. Since we're not able to do that this year because of the pandemic, and by the way, you see the lake behind me, that's where I'm living right now to keep myself safe from everybody. I'm kidding, that's a backdrop I don't know how to get rid of on the screen, so it looks nice though. In any event, in a way to try to reach out to all of the members of the Self-Storage Association, we decided we'd do this webinar and that I would provide a few minutes of reviewing some questions that were provided to me, as well as a legal issue that I've seen come up several times in the last 30 to 60 days. So with that, the first question that I received was the current state of eviction laws in the state of Colorado. As you all know, back in June, Governor Polis issued a moratorium on evictions for tenants. And then in September of this year, September 4th, the Center for Disease Control issued a national moratorium on evictions of tenants. The idea being, of course, that they don't want tenants leaving one home and going to another if perhaps they're infected with COVID. They'd rather have them stay in one place. The rents are not frozen. The rents still need to be paid by the tenant, but they cannot be evicted if they don't pay the rents, although they do have to be able to prove that they can't pay. So how does this relate to self-storage? Well, if you read the laws, specifically the moratorium issued by Governor Polis, I don't believe that it directly impacts self-storage. However, I would say that because the vast majority, I believe it's over 90% of the self-storage units in the state of Colorado are utilized by either people who own a property or people who are renting a property, therefore residential use. I think the political climate is such that for a self-storage operator right now to try to evict a tenant for failure to pay rent may fall on some pretty skeptical ears in a courtroom. Now, that being said, it's up to you whether or not you decide, you make a business decision whether or not you need to evict somebody who's not paying you at this point in time. And if you need to make that decision, I would strongly encourage you to speak to your lawyer, discuss it with him or her, and then based upon that discussion and that business decision and your lawyer's analysis of the current state of the law, decide whether you're going to go ahead and go forward with the essentially the eviction, but the lien sale of the property. The next question that I received was a question concerning transfer of a unit from one person to another or one entity to another, and what is the best way to do that? In other words, if you have a unit with personal property in it and somebody wants to transfer the name on that rental agreement to a different person or a different entity, how's that best handled? And you're going to need to make certain that you have a signed agreement between the old tenant and the new tenant, evidencing that both parties are agreeing to the transfer. You're going to then need to have the old tenant within that transfer agreement that you have both parties sign. You're going to need to have language that shows that that tenant is waiving, is really assigning his or her rights to all of the personal property to this new entity or to this new person, and that they are releasing the owner and or the manager of the self-storage facility from any claims relative to what the owner or management of the self-storage facility may do with that personal property in the event the new tenant were to fail to pay the rent. In other words, if a lien sale were to occur down the road after this transfer, you need to make certain that the previous owner has released his or her rights to all of that property to the new tenant, or whether it be a person or an entity, as well as release the owner for any owner or manager for any possible liability with how the owner or manager has to deal with that property in the unit. I recently dealt with a case where the renter of the self-storage unit had someone else's property in it, unbeknownst to the owner of the self-storage facility. That tenant didn't pay for the rent, the space went to auction, the property was sold, and the owners of that property, who had no contractual relationship with the self-storage facility at all, then sued the self-storage facility saying, you took our property, you created effectively it was a conversion, right, of ownership. And that case is actually still ongoing. So the idea being, if you're going to transfer from one person to another, you have to get an absolute agreement with the former tenant that they're releasing all right, title, and interest to the property within the storage unit, and they're releasing the owner and or manager from any claims relative to that property going forward. And then, of course, you need to do a new contract with the new person or the new entity for that space. Lastly, a couple things have come up recently that I wanted to bring to y'all's attention. The first one's pretty important. In order for a self-storage operator to have an effective lien on the personal property of their tenants, they need to have specific language in the contract. And the language is set forth in the statute in 38-21.5-101 at SEC. I pulled up the Big Easy, and on the very first page of the Big Easy contract, we have in bold letters a notice of lien, and that language specifically mirrors the language of the statute. And what it says that's very important is that the property, and I'm referring to the tenant's property, may therefore be sold or otherwise disposed of if payment has not been received by owner for a continuous 30-day period. You've got to have that language for a continuous 30-day period within your contract, along with, of course, the other language that the tenant hasn't paid, or else pursuant to the statute, you would not have a lien. Now, you might be able to make argument that the rest of the agreement provides the requisite notice to the tenant and gave him or her enough time and notice of the potential lien. But you got to have that specific language. So if you're looking at your rental agreement and you don't have that language, then get a hold of Maggie with the Self-Storage Association and get a copy of that Big Easy so that you have the correct language, and or just modify your existing contract to read what the language sets forth and what the statute sets forth concerning the language in 38-21.5-101. Lastly, another issue that came up recently is, what do you do when you have a tenant where you have to, because of some emergency situation, remove that tenant from his or her space? What do you do when you notify the tenant that you need to do that and the tenant ignores you? But that to keep all the other tenants' property safe within your building or whatever example, you've got to move this particular personal property out of your space. What you need to do is you need to move that tenant's property to another location and store it. If you just get rid of that property, you're going to argue, well, the tenant had abandoned it. We gave the tenant sufficient notice and they never came in, and we had to get rid of it. It was infested with something, with bugs or whatever. If you do that and you don't comply with the 38-21.5-101 rules regarding the disposition of a tenant's property, I think you're putting yourself in harm's way. So what you need to do is move the property, notify the tenant of the move, and when you move the property, videotape that move and do an inventory of all the property that you're moving so that you can show to a court, if it's ever challenged, that every box and everything that was in that storage unit was moved from one location to the other, and it's all on videotape, and all that property is still safe. You do not want to get rid of property without going through the lien law statute with respect to adequate notice for the tenant to come in and cure whatever default, and in this case, to cure by coming and getting his or her belongings. You don't want to be put in front of a judge where you haven't given the owner of that property many notices, several notices to come in and get their property before you dispose of it. Otherwise, the court may find that you've unlawfully taken that property and not given the tenant the proper notice. Those are the questions that I had that were presented to me, and a couple of those issues that I thought would be important to share with you today. As always, it is an absolute pleasure to work with all of you. It's a pleasure to work with the Colorado Self-Storage Association Board. And I wish all of you a great day, and I hope all of you are healthy and safe, and that we get to see one another in the spring. Thank you so much.